The Russian economy is headed for a deep recession and the imposition of capital controls. While there is some room for Russia to use its gold reserve and divert trade to China, Russia's financial system is set to come under enormous stress as it will struggle to meet its financing obligations despite running a current account surplus. Downward pressure on the ruble and capital flight have pushed the Central Bank of Russia to raise rates dramatically and impose capital controls. J.P. Morgan Research forecasts that Russia's economy will contract 35% quarter-over-quarter and seasonally adjusted in the second quarter, and for the year experience a GDP contraction of at least 7%. Inflation could end the year at around 17%, up from 5.3% forecasted before the crisis, with risks skewed heavily to the upside due to ruble depreciation and import shortages. Global Equities. The Russia-Ukraine crisis is a low earnings risk for U.S. corporates. However, an energy price shock amid a central bank pivot focused on inflation could further dampen investor sentiment. Domestic Russian banks, followed by European banks with local legal entities in Russia, are the most exposed to risk resulting from sanctions. U.S. companies have low direct exposure to Russia, around 0.6% for those in the Russell 1000 index, and Ukraine, less than 0.1%, based on disclosed revenues. Indirect risks could be more substantial, including slower global growth and consumer spending due to higher oil and food prices, negative second-order effects through Europe's supply chain distortions, credit and asset write-downs, cybersecurity risks. Tightening monetary policy remains the key risk for equities as central banks grapple with inflation expectations. Policymakers may also consider additional fiscal stimulus such as a U.S. gas tax reduction. Selected emerging market (EM) equities, particularly commodity exporters, should outperform amid a combination of higher rates and energy prices. Energy and materials, and Middle East and North Africa/Latin America would likely be the biggest beneficiaries, while healthcare and real estate stand to lose the most. European miners should see higher commodity prices due to supply dislocation of Russia-centric commodities. Palladium is the most exposed commodity, with Russia accounting for around 45% of total global production. Prices are up around 65% since mid-December 2021. Russia accounts for greater than 10% of global supply of diamonds, platinum and gold, while Russia and Ukraine combined account for in the region of 35% of EU27 steel imports. J.P. Morgan continues to expect an extended period of elevated geopolitical tensions and high-risk premium across all commodities with exposure to Russia. Reflecting the higher risk premium and given the large supply shock, Natasha Kaneva, head of commodities strategy, believes oil price will not only need to increase to $120 BBL but stay there for months to incentivize demand destruction, assuming there are no immediate Iranian volumes entering the market. If Russia were to use oil exports to exert pressure on the West, 2.9 MBD of crude would be at risk, which translates to a $50 BBL annualized price impact. China remains the wild card in this scenario. The country could opt to buy 1 MBD more of Russian oil at a steep discount and store it, without making any adjustments to its market purchases. On the other hand, it could reduce market purchases commensurately, freeing up to 1 MBD of supply from other sources. However, if disruption to Russian volumes lasts throughout the year, Brent oil prices could exit the year at $185 BBL, likely leading to a significant 3 MBD drop in the global oil demand. Even if shale production responds to the price signal, it cannot grow by more than 1.4 MBD this year given labor and infrastructure constraints. In natural gas, J.P. Morgan Commodities Strategy revised upward their summer 2022 title transfer facility, TTF, price forecast to €77.50, $85.95 per megawatt hour, Euro/MWH, to reflect the evolving geopolitical risks of the Russia/Ukraine conflict. This assumes that Russia would continue to honor long-term natural gas supply commitments to Europe, which could come into question, and removes the prospect of Nord Stream 2 commencing from our 2022 and 2023 forecast.